Hello, good evening, and welcome back to our lecture series on mock paper of ACCA Financial Accounting. Question number 32. Identify by selecting the relevant boxes in the table below whether the following material events which occurred after the reporting date and before the financial statements are approved adjusting events. So now this is standard IAS 10. Events occurring after the balance sheet date, post balance sheet event, or events subsequent to balance sheet date. Any way you can call it. So there are two types of events. One is adjusting event, the other one is non-adjusting event. Here they have given you 4 examples. We need to find out whether these events are adjusting or not. The condition is that there are two requirements. First, you have to see any given instance is a condition existing at the balance sheet date and the subsequent events are demanding or requiring an adjustment to our current balance sheet period. When I say that, now if you see here, this is my current accounting period, 1 January 20, 31st December 20, and this is the financial statements approved for publishing by board. Let's say 6 June 21. So I'm talking about events during this period. This is what I mean post balance sheet events. So based on that, in these examples what they gave, we need to find out whether any of them are pertinent to our current accounting period. So when I say current accounting period, that is this period. Yes, please be clear on that. Evaluation of property providing evidence of impairment in value at the reporting date. Now, if you look into this property and you carrying out a valuation subsequent to balance sheet date, that means already the property available at the balance sheet date, a value has been stated in the property, plant and equipment, and subsequently due to conditions leading to an impairment. So this is an example of adjusting event which to be adjusted in my current accounting year. So the answer for that will be yes. Second one, sale of inventory held at the reporting date for less than the cost. Now usually in inventory we account it using IAS 2. IAS 2 states that you have to value the inventory either lower of cost or NRV, whichever is lowest. So normally when we producing the financial statement on the balance sheet date, we should value at cost, and subsequently if the inventory is resulting into a value NRV, meaning net realizable value, the calculation of net realizable value is future estimated selling price. You subtract the total of future completion cost and the any future selling expense. So this answer, if that answer is less than the cost of inventory, then we have to adjust it accordingly. This also we needed to adjust for the current accounting period. Discovery of fraud or error affecting the financial statement. Remember, when any fraud or error reflecting and affecting the financial statement subsequent to balance sheet period or balance sheet date, also we needed to adjust. So that also answer yes. The last one, the insolvency of a customer with a debt owing to the reporting date which is still outstanding. Please remember, one example of adjusting event given in the standard is this fourth one. So that also an adjusting event accordingly. All 4 options answer is yes. Question number 33. This question is talking about inventory valuation. Inventory valuation, we have 2 methods, FIFO and weighted average. Remember, LIFO is not accepted as per IAS 2. Here they are following FIFO. And what they are saying that at 1 May 2005, the company had 700 engines in inventory, valued at 190 each. During the year ended 30 April 2016, the following transaction took place. 1 July, they purchased 500 engines at 220, and then 1 November, they sold 400 engines at 160,000. Remember, when valuing inventory, the sales value is not a relevant information for us. In 1 February 2016, they purchased 300 engines at 230, and 15th April, they sold 250 engines. What is the value of the company's closing inventory of engine at 30 April 2016? You see, we have to use FIFO method. So we have opening inventory value, there are 700 engines, and when we are using FIFO method, whatever I had at the beginning, I have to release that. Then only I should release from the items that I purchased subsequently. Accordingly, from the 700, I have released 400, so I need to subtract that. So I will subtract that 400 first sale, and then also the second one, I have sold another 250 engines. So the second one, that is another sale. So the difference here, you see the total of these two is 650, that is 700, so 50. So this is the first part of the valuation. So this we need to evaluate 190. The second one, we have two more purchases. The first purchase is 500 at 220. So what you do is 500 at 220. Second bunch of purchase is 300 at 230. So if you use a calculator here, so what you do is 50 into 190, that gives you 9,500, and then 500 into 220, that gives you 110,000, and then third one, 300 into 230, that gives you 69,000. The total of these three will be the inventory at the end, inventory value. So that will be, let's see the total, 188,500. So that will be the answer for this particular question, 188,500. That is option number 1. And question number 34, Amy is a sole trader and had assets of 569,400 and liabilities of 412,840. That's on the 1st of January. Now, during the year ended 31st December, she paid 65,000 capital into the business and paid herself wages of 800 per month. At 31st December 2018, Amy had assets of 614,130 and liabilities of 369,770. Question is, what is the profit for the year ended 31st December 2018? What we do is here, there is an equation. This equation is actually at the very beginning of financial accounting lecture series, and if you need more clarification, do please visit my previous relevant videos. Anyhow, the equation is P is equal to I plus D minus CI. When the meaning of I actually net assets at the end minus net asset at the beginning. So therefore, what you do is P again NA2 minus NA1 plus D minus CI. Now we are very clear that D, they say the owner has taken salaries of how much? 800 per month. So in a year, how much? So that is 800 into 12, which is 9,600. So the owner has taken 9,600, and the additional capital introduced by the owner to the business is 65,000. So that is the additional capital. Now we have to calculate net asset at the beginning. That will be total assets at the beginning minus total liability at the beginning. So let's find out. The total assets at the beginning is 569,400. 569,400 minus the total liability is 412,840. So let's find out the difference here. 69,400 minus 412,840. So that result into how much? 156,560. And then we also need to work out NA2, that is total assets at the end minus total liability at the end. The number 1 and 2 means the beginning of the accounting period and the end of the accounting period. So total assets at the beginning 600, at the end 614,130, subtract or minus 369,770. So now what you do, we find out the difference for that. 614 130 minus 369. So 244,360. 244,360. Now accordingly profit will be equal to 244,360 minus 156,560 plus drawings 9,600 minus additional capital introduced 65,000. Let's work out. So that will be let me calculate. 244,360 minus 156,560 plus 9,600 minus 65,000. 32,400. Answer is 32,400. And that 32,400 is your answer for this question. So in this box you need to type 32,400. Accordingly, we are concluding now 34 questions, and there is one more question on the multiple choice. Please remember, mock exam, or this is the exam format. There are 35 questions. Each question carries 2 marks, so 70. And then they also have multiple task question, which will have each question 15 marks. There are 2 questions, so we'll be together 100, but you need to score only 50. Thank you so much, and wait for my further video lectures on the same topics.